The trade conflict, especially between the US and China, is causing major disruptions. If tariffs between the two countries stay where they are, we expect a supply-driven contraction in US activity this year. Yet, if economic rules keep spurring policy changes, the drag could be lower. The uncertainty around US tariffs is evolving into difficulties akin to what US companies faced during the COVID-19 shock, when they struggled to get key inputs for goods. The hit to activity ultimately depends on where tariffs land. If economic rules keep binding, damage could be limited. We have seen several tariff exemptions made already, including with China. What's important is the impact on the long-term growth trend for the US. As the impact of trade disruptions ripples through the economy, we're tracking a range of indicators to gauge what the damage will be and how long it'll last. We expect tariffs maintained at current levels to cause a supply-driven contraction in activity this year and eye a range of indicators for pressure. Yet economic rules binding policy could limit the impact, keeping us overweight US stocks.